I think we've given the stragglers enough time to show up, so I'll get started now. I'm Kyle Green with Green Mortgage, and I'm here to talk to you guys today about whether your mortgage is tax deductible or not. The highlight of what I'll be speaking about today really is coming down to whether you're paying too much in tax. So welcome to the presentation. Here's the table of contents. We'll be going over a number of different things, but the first thing I want to talk about is how expensive a mortgage really is, how to save for retirement, good debt versus bad debt, using your home equity, what to invest in using your home equity, what the Smith maneuver is all about, tax savings, what our clients are doing, and how you can learn more about the Smith maneuver. So let's get started here. Let's talk about how much a mortgage really costs you. So if we take a $450,000 mortgage at 1.99% interest, 25-year amortization, and a 44% tax rate. First of all, if you paid that mortgage out over a 25-year period, your interest cost would be $121,000. Now, it's important to note too that this is a much lower interest cost than if the interest rates were much higher. So we're at all-time low interest rates, and yet the interest cost over 25 years is quite substantial. Now, keep in mind, you still have to repay the principal back, right? So you have the interest cost plus the principal back. Now, here's the crazy part, is the amount of income required to pay this amount. So between the $450,000 in principal and $121,000 in interest, if you're paying 44% tax, you'd have to earn almost $1.3 million in income just to pay for all of this. So it's quite expensive. A mortgage is not a cheap thing whatsoever. So if we look at what you're supposed to be doing, or what people are taught, it's always, hey, how do I save up for retirement, and what is the best thing for me to be doing? Should I be increasing my investments or paying down my mortgage, and trying to fight for that and figure out what the best route is? Obviously, with the amount of interest costs that accumulates on a mortgage, a lot of people are drawn to paying off that mortgage. Some people don't pay off the mortgage very aggressively, and instead they increase their investments. But what I want to tell you today is you can actually do both. And there's a really cool strategy that will allow you to save a lot on tax and actually pay down your mortgage and increase your investments at the same time. One of the concerns, of course, is that many Canadians are woefully prepared for retirement. Many are focused on paying off their house, but really only have a fixed income. And so once they have their house paid off, they don't have any additional income, really. Now that they don't have that debt, great. But of course, when you hit retirement, sure, you have a lower debt load, but your income level has dropped significantly. And so a lot of people are now looking at reverse mortgages. And then as a mortgage broker, I see that myself. Reverse mortgages are up 30% year over year. There's more and more lenders wanting to create reverse mortgage products for that exact reason. So it's getting harder and harder for people to look at retirement and figure out, hey, how can I retire? Paying off your mortgage and just paying off your house is not a reasonable expectation for a safe and solid retirement plan. Not to mention, there's all these concerns about, will the Canadian pension plan actually have enough money for you when you retire in 30 years, 20 years? There are major concerns about that too. And so I think that it's important to try and take retirement into your own hands and figure out a game plan that would work for you. So one of the things I like to explain is what good debt versus bad debt is, and understanding the difference. It's important to minimize bad debt while using but not abusing. Actually, that should say good debt. So first of all, bad debt. Let's talk about what bad debt is. Bad debts are anytime you're borrowing money to buy depreciating assets, consumer goods, for instance. If you're putting groceries on a credit card and you're consuming those groceries, you're buying a depreciating asset, technically. Of course, we all need food to live, but putting those types of expenses on credit is not considered good debt. Neither is buying a car, for instance, unless it's a old classic car that's expected to appreciate in value. So really what it comes down to is borrowing money to buy depreciating assets is considered bad debt. The next step here is good debt, and that's borrowing money to buy appreciating assets. So if you're borrowing money to buy real estate or stocks, at least if you're borrowing money, but you're investing it and putting it into assets that will increase in value over time, that's called good debt. What I really want to talk about a lot about today is actually taking good debt a step further and talking about tax deductible debt, which is even better. So you're still buying appreciating assets in real estate, stocks, etc., but you're even being able to now write off the interest portion of the payments because you're now borrowing money to invest. And we'll talk a little bit about how that works. So ultimately, at the end of the day, people can be very concerned about borrowing money and what that looks like. And that's why a lot of people have this fear of borrowing money to invest. So what I want to talk to you guys about is really everything that we talk about is focusing on net worth. So net worth is your goal. We're looking at what is your assets minus your liabilities, and that really comes down to your net worth. So it's assets, what you have in assets, minus your liabilities, and then calculating the net, and that's why they call it a net worth, right? One of the ways of increasing your net worth is to use your home equity. A home paid off is not working for you. Other than appreciation, there is no gain owning real estate, right? Once you have this thing paid off, sure, it might appreciate at a rate of average 3% per year. In many markets in Canada, it might be an average of 6% per year over the last 25 or 30 years, but you're not really getting much more than that. And so it's really important to understand how to utilize and use your home equity to work for you. So how do we do that? The very important key here is just to create a spread on your money, okay? So here's what we look at doing. We want to invest the money at 8% and borrow it at 2.95%. So as of right now, a line of credit, a secured line of credit is prime plus 0.5, 2.45 plus 0.5 is 2.95. So one of the things that we want to do, and we teach a lot of our clients, is if you can borrow money at all-time low rates and then invest that into something else that has a higher rate of return, you're creating a spread on money that you don't even have. All you're doing is tapping into your home equity to access capital and then investing that. So for instance, if you had $100,000 you could tap into and you just accessed your home equity, got a mortgage or a line of credit on that, borrowed against it and invested it into something that returned 8% for you, you're making $5,000 per year in money that you didn't even have in your bank account, which is really, really cool. Now, start to accelerate that and look at maybe $500,000 instead of just $100,000. Now we're talking about $25,000 per year that you're earning just by accessing your home equity and investing it and creating a spread between your cost of borrowing and your investment returns. $25,000 a year is $2,000 a month. That's enough to live on for most people if you're in retirement. So something to look in and to consider for sure is using but not abusing the home equity that you have available to you. So the question we get a lot is, well, what do you invest in? And there's so many different options out there. I'm only going to talk about a couple of them today. But the first one, of course, for those of you that know me, a lot of our clients are real estate investors. So that's a big thing that we focus on is how to invest in real estate and how to grow a real estate portfolio by basically borrowing money against your home equity in your residence and using that for down payments to buy rental properties. Another thing that's very common and very popular is investing in stocks, investing in growing companies. So buying stocks that you think will appreciate. And of course, I'm biased. I think real estate is way better than stocks, but I still believe in stocks, and I still think that it's good for you to have some kind of balance in your real estate and just your portfolio in general, and having some real estate and stocks in there is advisable. There's also other investments, so private lending, private equities, et cetera. Lots of different things that you can look at investing in. It's just important to understand that there's many different avenues and routes that you can take to using your home equity to invest in different things. So going back to this chart here, we've had an opportunity to talk about, well, how do we take advantage of good debt, aka borrowing money against our home equity to then invest? What I really want to talk about now is how do we structure your mortgage to save in tax? How can we build a structure here that allows you to grow your net worth and save money in tax at the same time? So here's the magic. I'm calling it magic because it is, of the Smith maneuver. So here's an overall concept of how the Smith maneuver works from a high level. So basically what you're doing is you're generating increasing tax deductions monthly just by paying down your mortgage. And what you're doing is you're essentially paying down your non-tax deductible debt faster and faster. And then you're having access to more money that you can use to invest, which continues the cycle. And it's a bit of a snowball effect. As you have more income coming in from your investments, you're able to pay down your non-tax deductible debt faster and faster and faster. And that allows you to continue to increase and basically switch your mortgage from being not tax deductible to being tax deductible. And don't worry, I have lots of graphs and charts for you guys to look at because this is a bit confusing, but I'm going to be able to explain this in an easy way. And one of the best parts about this is it's easy. It's not even that difficult. It's not rocket science. It requires little to no money to set up. Really, all you need to do is if you don't already have a readvanceable mortgage, which we'll talk about in a second, then all you have to do is use a broker or talk to your bank about getting a readvanceable or home equity line of credit is commonly called. And this product is going to allow you to start saving money in tax right from day one. So let's talk about how it works. Essentially, what you're doing is you're making your mortgage payments on your mortgage, and then you're going to re-borrow the principal that you've paid down on the mortgage. So readvanceable means that you can re-advance the principal you've paid down in your mortgage without having to requalify, which is really cool. So what you're doing then is as you pay down your mortgage, you're going to re-borrow the money that you've paid down, and you're going to invest that money. And whenever you borrow money to invest with the intention of earning an income, the money is tax deductible. I do have to put in a disclaimer here that make sure you speak with an accountant to make sure that any tax things that you're doing, you run it by your accountant to make sure that it's green lighted and it's okay. So let's talk about what a regular mortgage looks like. So if you bought a $500,000 property and put $100,000 down, this is your standard mortgage. Nothing really happens to it. So you're paying down your mortgage and you don't get access to the equity in the home or anything like that. It's just a regular mortgage. So it's not tax deductible. Now let's take a look at a readvanceable mortgage. So in this case, a readvanceable mortgage means that you have a mortgage and then a line of credit component. Now on day one, you can see that there is no line of credit limit available at this particular moment. So you still have $400,000 that's not tax deductible. But what happens is, as you slowly pay down your mortgage, your line of credit limit will slowly increase. And so now in this case, let's give you an example here. On your $400,000 mortgage, your mortgage payment might be $1,692 a month. Your interest costs here would be $660 a month. And that's the amount that you're flushing down the toilet. Sorry, goodbye interest. However, the principal, so you've paid down $1,031 on the principal. What happens to that? Well, now it actually pays down your mortgage a little bit. And now your mortgage balance goes from $400,000 down to $398. And now your line of credit limit goes up by $1,000. So now you have access to additional credit, which is really, really cool. And all you're doing is just paying down your personal mortgage, which is then increasing your line of credit. And now you have $1,031 that you can now reborrow and use that to invest. Now, again, I want to highlight this because this is really important. It's the use of funds and what you're using the money for, okay? So you have to be using it towards things that are increasing your net worth. Let's talk about consuming, first of all. If you're borrowing the money for consumer items, these are not tax deductible. You cannot borrow the money on the line of credit to go buy a nice car, to go out for dinner, etc. You have to be borrowing the money with the expectation of generating an income. So it really comes down to, and the term that I use a lot is borrowing money to invest. And that creates a tax deductible mortgage. I'll give you an example of this because this comes up quite a bit, especially with our clients that have rental properties. It's not the property that you're borrowing the debt against that determines whether it's tax deductible or not. It's actually the use of the funds. So this is where if you have a personal residence, which typically would not be tax deductible, but if you borrow against it to use money to invest, then the money is tax deductible. In the reverse, however, we do have some clients that actually have a rental property that's nearly paid off, and they borrow money against the rental property to go buy a personal residence. Now, just because the debt is secured by the rental property does not mean that it's tax deductible, because the CRA will look at what money or what did you use the money for. If you used it for personal use, aka a personal residence, then that debt is not tax deductible. So again, it's very important to understand the difference here, and it really comes down to the use of funds. So over time, what's going to need to happen is you're going to be continually paying down your mortgage, and then you're going to see that now your line of credit limit continues to increase. And so now on that $400,000 mortgage that we used to have, maybe now $225 is borrowed on the mortgage portion, but now the line of credit is at $175. So in total, between the two, you still have $400,000 in total credit available to you between your personal non-tax deductible mortgage and your secured line of credit that you have. And slowly over time, you're going to continue to pay that down, and it snowballs a little bit. So now you're borrowing and reborrowing more and more and more to go out and reinvest those funds. Now, over time, eventually that mortgage gets down to zero, and your entire mortgage is now tax deductible. And now you're borrowing all of that money to invest. And at this point, if you've done this correctly, now your $400,000 is all tax deductible. So the big question, how much do you save when you do this? And the answer is, it's a lot. It's a lot. I'll go through some math, because I know there's some math geeks here for sure that are dying to get into the tax stuff. So let's go through some calculations. Let's assume that there's a 44% marginal tax rate. Let's assume that the interest cost is 2.95%, which, by the way, I should mention, a lot of lenders, not all of them, but a lot of lenders do allow for you to lock in portions of your line of credit into mortgages. And typically a mortgage rate will be lower than a line of credit rate. And so if you're looking at doing something like this, and you're looking at borrowing the money for an extended period of time, like if you're borrowing money for a down payment for an investment property, we typically will recommend that you don't keep it on a line of credit, which is a higher interest rate. You actually lock it in or convert it into a closed fixed term or closed variable term, and that will get you a much better rate. But for the purposes of this this situation here, I'm going to assume that you're borrowing all of the money on a line of credit, which is interest only. So at 2.95% interest on $400,000, that's $11,800. Now, if you're at a 44% tax rate, you're now writing off $11,800 on your tax return. So if you're writing off $11,800, you're saving $5,192 per year in taxes. Now, over time, of course, you have to remember that in the very beginning, you're slowly ratcheting this amount up. And so you're not going to save $5,200 right from the beginning. But over time, as you slowly convert it, you're going to be building up your tax deductibility and the amount of interest that you're able to write off. And this will slowly increase. There's a lot of different unique things that we can talk about how you can save a lot of money immediately just with very, very small switches. I'll talk about what some of our clients are actually doing. And so a lot of our clients right now are looking at reducing their payments and paying off high interest debt by refinancing. And so if you're looking at setting up a home equity line of credit style mortgage, a readvanceable product like this, a lot of people also look at, well, maybe what I should do is I should access some additional capital and pay off some high interest debt that I have. Maybe I should lower my payments while I'm at it. Especially for our real estate investors, extending your amortization out to 30 years will give you a lower minimum monthly payment that then allows you to go out and qualify for more debt when you go buy rental properties. So a lot of the time, the residence becomes the hub of your investing strategy, regardless of whether you're investing in stocks or real estate. It's very important to set this residence up, and that's where our team can give you a lot of good advice on how to structure that. By the way, I'm going to answer all the questions at the very end. So just a heads up, I'll make sure that I'll get to every question that you guys have, and I'll open up for some questions at the very end. One of the things that a lot of our clients are doing is learning how the Smith maneuver can save them thousands in taxes with very simple changes. I have an easy example of this actually. So I had a client who had an ICBC settlement, and she was going to use her cash for down payment. In fact, she talked to her banker already, and her banker said, yep, no problem. You're approved. Go ahead, go buy a rental property, and we're going to use that cash. However, one of the keys here is by restructuring her mortgage. So what we did is we actually took the $100,000 in cash, and we paid down her mortgage by that much. But then we gave her a line of credit behind it that was available to her so that when she found an investment property, she still had that credit available. So then what she did is she went out and then she found a rental property and then borrowed her down payment from her residence. It was a very, very simple maneuver, but simply by giving her a little bit of tax advice and saying, hey, make sure you go talk to your accountant. This should work for your situation. But now if you're reborrowing the $100,000 back out, at the time interest rates were around 3%. So that's about $3,000 per year in interest costs she's now writing off. And based on her tax bracket of around 25%, she's now saving about $750 per year in taxes every year. It's pretty substantial, and it's a very, very quick, simple maneuver. And there's a lot of more complex maneuvers too that I won't get into today, but there's a lot of more complex maneuvers that a lot of our clients are doing as well. Getting access to capital and investing it to earn a spread on the interest versus the return. I've actually had a number of clients that broke their mortgages, and even at some periods of time, obviously in the last little bit, interest rates have come down significantly. However, I've even done this for clients when interest rates were rising and they broke a mortgage at a lower rate and to take a higher rate. So they paid a penalty, got out of their lower mortgage rate, took a new higher interest rate, also that they could get access to an extra $100,000 or $200,000 in capital. And you'd wonder, well, why is that? Why would you pay a penalty to get rid of a mortgage rate that's at a lower interest rate? Because you'll have to look at the full picture. If this client, and I'll use one client in particular, he was getting access to another $200,000, and he had some investment ideas where he figured he's going to get something like 15% return on his money, which, hey, I thought that was a little bit high, but he was pretty sure that he's going to be able to get that. So by investing that money at 15%, and at the time his cost of borrowing was a little under 5%, he's creating over a 10% spread on $200,000. That means he's earning $20,000 per year on an ongoing basis by breaking his mortgage and paying this penalty. So his cost to break his mortgage and get into a slightly higher interest rate was only costing him about $2,000 per year on the difference in interest. And so he was way ahead. His net savings and his net worth increase per year is actually going up by $18,000. And so again, it can sometimes make sense to break your mortgage and pay a penalty if you're going to get access to more capital, and if you're going to use it to invest, and you make sure that you run the numbers on that. Another thing that, of course, a lot of our clients are doing is utilizing their home equity to buy rental properties. And again, that's one of our niches here at Green Mortgage is accessing home equity to buy rental properties. Now, there are a lot of different strategies as well that can get you there even faster. So the Smith Maneuver Accelerator. So there's a number of different options here. There's something called the debt swap accelerator. And that's actually the example I gave you with the lady who used her ICBC cash. That was actually a debt swap accelerator move. So that was just taking assets that you have already, using them to pay down your mortgage, and then reborrowing back out to reinvest. And you can do this with stocks. You can do this with a lot of things. So it's a very, very cool way of doing it. There's also something called the cash flow diversion calculator, which is essentially a way of taking the cash flow from your investments to pay down your mortgage even more aggressively. There's a number of other options here. There's prime the pump, cash flow damming, which cash flow damming is a very complex strategy. And for those of our clients that have a lot of rental properties, we do advise that they look into it, especially if they have a lot of rental income. It's a little bit more administratively intensive. A lot more action has to be taken by the borrower, but the tax savings can be quite extreme if you do that. And so if you do want to learn more about some of these strategies, feel free to check out our website. We have a ton of information on our website, and if you're interested, we can get you more information about the Smith Maneuver Calculator. There's also a course that Robinson Smith is offering on his website at smithman.net. So you can learn a lot more about the Smith Maneuver Calculator. There's a course, and of course, there's a lot of FAQs and questions that a lot of you probably have. So it's good to check it out, learn more about the program. So it's time to start getting your retirement strategy in place. Make sure that you book a consultation with us today, learn more about how we can help you. By the way, the first 5 people that book a consult with us to learn more about the Smith Maneuver, I'm going to send you a copy of Robinson Smith's book. I have a bunch of them here at the office. And so the first 5 people that book a consult with us will get one of these books. And by the way, while we're talking about books, I'm also a best-selling author myself. Not to take away from Robinson's thunder at all, but I also released Rockstar Real Estate Investing a little while ago, and it's a book all about real estate investing. And so if you'd like a copy of that book, please reach out to us and contact us. So if you'd like to reach out to us, here's our contact information. You can visit us at www.greenmortgageteam.ca, and email is info@greenmortgageteam.ca. Phone number 604-229-5515. Thank you, everybody. What I'll do now is I'll open it up for some questions. I think I had a question or two in the chat here, so let me just open those up. So one of the questions is how much loan to value on the property do you need in order to be able to borrow money? So the maximum loan to value that the lenders will offer under the a readvanceable program is 80% financing. So they will not finance more than 80% of the value of the property. So if you put, let's say, 5% down on a property, then you need to be able to pay down your mortgage down to no more than 80%. A lot of our first-time home buyers, what they'll do is they'll buy a property if they want to get into this, but they don't have enough down payment. Then they'll put 5% down, and then eventually, when the mortgage renewal comes up, hopefully by the amount that they've paid down in the mortgage, and if the value has increased, they may now have that 20% equity in the property that they need in order to be able to do that. Are there any other questions? Thank you. Actually, good question. So yes, we actually have a Smith Maneuver certified individual at our office, and one more of our staff members is going through the course right now. I think he's very close to being done. So very, very soon we'll have 2 Smith Maneuver certified individuals and agents at our office that are well educated and very well versed in being able to help you and dive into this, and also go into a little bit more of the advanced strategies that I spoke about very briefly today. Let's see here. So the money that you're able to take out from the property is only what is on the mortgage or based on the total value. So what happens is when you go to qualify for one of these readvanceable mortgages, you have to qualify typically based on your income. And so it's not just the total value of the real estate that you're able to access. That is one factor, but you have 2 limiting factors here. Number one is what your income will qualify you for. The other factor is you still can't go above 80% of the property value. So typically what the lenders are looking at is no more than about 44% of your gross income being used towards all of your debts. Here's the easy math. If you have no other debts, or if you're going to roll the debts into your mortgage, every $20,000 in income would qualify you for about $100,000 on a HELOC or home equity line of credit. I've got another question. So which lenders offer readvanceable mortgages? So most of the major banks offer readvanceable mortgages. However, some readvanceable mortgages are better than others. And this is where some lenders, for instance, only have 1 mortgage and 1 line of credit component, which is not very good for a lot of our real estate investors. There's a number of different nuances with every lender. Some of them allow a number of different mortgage or line of credit portions inside of it. Some lenders will allow you to qualify for more money. And some lenders even have a program or product where some of your income that comes in as you get paid will actually pay down your mortgage even faster. And so it can accelerate this method of paying down your non-tax deductible debt even quicker and opening up available money in the line of credit even faster. So it's something to keep in mind, is that your bank probably has a product of some sort, whether that is the best product in the marketplace or not. That's something that you probably should get a Smith Maneuver certified professional to answer. Let's see here. I've got another question. Does it matter if the mortgage is on variable or fixed? No, it does not. The qualifications as of right now anyways are exactly the same, whether it's a variable rate or a fixed rate. Most lenders do offer a variable and a fixed underneath the mortgage components. There is one lender that only offers fixed rates under the mortgage components, and then the lines of credit are all variable, of course. But for the most part, it doesn't really matter whether you're fixed or variable. It doesn't affect the HELOC component or the readvanceable component. Let's see here. So I've got another question. Can't I just go to my bank and get a readvanceable? Yes, you can. Again, though, the products are very, very different. So yes, you could probably go to your bank and get a readvanceable product. Is that the best readvanceable product? That's another question for sure. And that's where we advise that you get some coaching and advice on whether that's the right product for you and which one is the best product. Another question, do I need Smith Maneuver certified professionals for anything other than my mortgage? Yes, I mean, realistically, what's happening here is the mortgage happens to be the hub and the central facility for everything else happening, but it's really important for you to get advice on all of the other key components to this. So accounting is probably the number one big thing that you need to make sure you get really good accounting advice. You need somebody that understands this product. There's a lot of accountants that do not understand the product well enough to be able to properly advise you on this. And so we do advise that you make sure that you get connected. The cool thing about the Smith Maneuver program here is that there's a really good community of individuals who are Smith Maneuver certified. So it's not just mortgage brokers, it's accountants, we have financial planners. There's a number of different people that are in this sphere, including even realtors, who can better advise you on what the best way to structure this is, because everybody involved in this whole transaction of buying and owning real estate and doing your taxes, et cetera, they should all understand how this is all intertwined. You don't want to get advice from one person and advice from another person, and everybody has their own biases. But if you have a group of people that are all like-minded and all are Smith Maneuver certified, then it makes it a lot easier. I have a question about advantages between HELOC versus refinancing. So a refinance can be adding a HELOC to your mortgage. So the act of refinancing just means that you are restructuring your current mortgage. Restructuring could be just giving you a regular mortgage, or it could be giving you a HELOC product. One of the advantages of just a regular mortgage is that you're just getting, in general, the mortgage rate on all of the money that you're borrowing. Now, some lenders do not have a home equity line of credit product. There's a lot of non-bank lenders that we work with, for instance, that are just really competitive on the interest rate, but they don't have a line of credit type of product. So sometimes, in some cases, some of our clients will opt for that. But I will say that most of our clients who are investors, who want to be saving money in tax and plan on investing some way, shape, or form, even if there's a small difference in the interest, the amount of tax that you can save greatly outweighs the amount in interest that you would be paying to get this product. Another question, does this cost me cash out of pocket each month if my line of credit balance is rising? So technically what happens is, as you pay down your mortgage, your line of credit limit is increasing. However, if it's just the limit, it's not costing you any money. Having access to capital available on your line of credit is not costing you anything. However, if you do start to take the money out, then your payments will start to go up. And so this is the beauty of the product too, with clients that are getting ready and set up to go out and invest. A lot of the time we'll say, hey, you know what, you might not need the money today, but why don't we get you a mortgage for the amount you currently owe? And then let's get you a line of credit on top of that, over and above the amount that you need. And now you have access to capital for the future. And now you don't have to worry about having to go back and requalify. And on top of that, as you pay down your mortgage, your line of credit limit will slowly automatically increase. So it doesn't cost you anything per month to have access to the capital. Eventually, when you do decide to borrow it, then yes, there is a cost. If it's a line of credit, then it's interest only. And if you decide to lock it into its own mortgage term, then it would be based off of a 25 or 30-year amortization, or whichever amortization you choose. I have another question. Is it possible to use line of credit not tied to home equity for buying rental properties? So from a tax perspective, the answer is yes, you can. From a mortgage qualification perspective, the answer is no. So lenders typically need to see in the verbiage on this is that lenders want to see if you're buying a rental property that you're using your own funds, so your own down payment. And this means that if you're borrowing money from an unsecured asset, that is not your own money. However, they feel that if you're borrowing money from a secured asset, like real estate backed, then you're basically just getting access to your own money. That is the way that they feel about that. So borrowing money against an unsecured line of credit is not a valid source of down payment, unfortunately, especially for rental properties. Sometimes for owner occupied, there are some lenders that will consider it as long as you can pay for the payments. In general, lenders use a very high payment. So I think the payment on $15,000 of unsecured debt is higher than borrowing $100,000 on a mortgage, even with the stress test. And so they use a very aggressive payment for that. I've got a question in the QA here. So can you think of any monoline lenders who offer home equity lines of credit? And yes, the answer is yes. There are a couple of monolines. Not a lot of monolines offer a line of credit, but there are a few of them. I do find that they're a little bit more restrictive, unfortunately, and I really do like monolines. One of the reasons that I like monoline lenders, and for those of you that don't know what a monoline is, it's a lender that just offers one product, just a mortgage. So we call them a monoline or one line. These lenders, they typically have a difficult time funding lines of credit, and the reason for that is that most banks actually go out, lend money out to you and me, and then they bundle up mortgages together and sell them. Now, monolines don't have a balance sheet. They don't take in deposits. And so it's very difficult for them to go out and actually offer lines of credit because they don't have money sitting in the bank account ready to use for lines of credit. And it's very hard for them to bundle up these mortgages and then sell them out the back door, because it's really hard to sell to an investor, hey, here's a bundle of lines of credit. The clients may or may not use them. I don't know how much money you're going to make on it, but you have to have the money sitting aside in a bank account. So it's not easy for monolines to offer these types of products. The reasons I really like monolines is the way that they calculate penalties, especially on 5-year fixed rate mortgages. I find that the penalty cost with monolines is significantly cheaper than it is for major banks. In fact, in many cases, 3 to 5 times cheaper. But unfortunately, most of the monolines don't have the same product with as much flexibility. MCAP is a lender that I do like, and their product is fairly good. The only real 2 restrictions on that is that it's 1 mortgage and 1 line of credit, and it's max 25-year amortization on the mortgage portion. Let's see here. Another question. Can I build up a portfolio of stock with the monthly investment amount of $1,000 or so until I have enough of a down payment on a rental, and then sell the stock and put a down payment on a rental? I'm quite positive that you'd be able to do that. I would say that it's important for you to talk to your accountant just to make sure that there's no reason that you could not do that. But you should be able to do that. So you could basically just, as you pay down your mortgage, keep reborrowing the money back out, put it in stocks, slowly build that amount up. And eventually, once you have enough stocks, take the stocks, sell them all, pay down your mortgage. Now your line of credit bumps up again, and now you have a down payment that you can invest and borrow to invest. And now your interest is tax deductible on that portion. It's a very good strategy, Robinson, actually, because you'd be earning an income on the stocks while you're investing in the stocks at the same time too. So you're creating that spread that I talked about earlier, which allows you to accelerate it faster. And in fact, what you could do is with the gains on the stocks, on any dividends that you're earning from the stocks, you could actually take the dividend income from your stocks and use that to pay down your mortgage even faster too. Obviously, it depends on how much money you have invested in the stocks. If it's $1,000 per month that you're putting into it, you're probably not going to have a ton of dividends. It's any significant tax savings, really. But if you have a larger amount, then definitely you'd have a pretty significant tax savings. To obtain a HELOC, is your income taken into consideration, I assume? And the answer is yes. Yeah. So it is a common misconception that people think, oh, well, this isn't a mortgage, this is a line of credit, so I should just be able to get it. But a mortgage and a line of credit from the lender's eyes are the same thing. It's still secured debt. And in fact, it's actually slightly harder to qualify for a line of credit because of the way that they qualify the debt. So when you get a mortgage, they say, okay, if you're taking a 30-year amortization, then we're taking a 30-year amortization at the stress test interest rate, and that's the payment we use to calculate the payments. When you get a line of credit, they say, well, we're going to factor in on the entire limit the stress test rate, but on a 25-year amortization. So it can be much harder to qualify for a line of credit than a mortgage just because of the difference in amortization when they calculate the stress tested payments. These are good questions, guys. Any other questions? Well, if anybody else has any questions, or if you'd like to learn more, I'm also going to leave a link. Michael in our office is Smith Maneuver certified, and he's more than happy to answer any questions that you guys have. If you do want to book a consultation, you can actually click here and click the link to do that. Or of course, go to our website and check out some of the materials we have online, and you can book a consultation with us that way too. And again, just a reminder, the first 5 people that book a consult with us will get a free book in the mail. I'm going to send over Robinson Smith's new book that he wrote about a year ago. I think it came out. So if any other people have no more questions. Oh, one more question. Where do I get my haircut? Actually, funny story. My hairdresser, the shop that he was working at just closed down, so I might have to find a new hairdresser. But thank you, Alejandro. I know, thank you. I do take very good care of my hair and get a lot of compliments on it. So I'm going to miss my barber. All right, guys. Thanks so much. It was great to see a lot of friendly faces here. And if anybody has any questions, feel free to reach out. Thanks so much, guys. Bye.